Welcome to the latest episode of our podcast series for financial advisors. Today's episode is the annual report on recruiting, deals, and transitions, an industry update on 2025 activity. It's a conversation with my partner, Louis Diamond. I'm Jason Diamond, and this is the Diamond Podcast for financial advisors.
At Diamond Consultants, we help elite advisors identify the right environment for their businesses to thrive, whether that's at a wirehouse, boutique, or independent firm. With nearly 3 decades of experience, we've guided thousands of advisors and represented more than $250 billion in assets transitioned. And each year, 1 in 4 advisors managing $1 billion or more who change firms are our clients. Our process is education-driven and based on building relationships, starting as your strategic partner well before you're even thinking of a move. To schedule a confidential conversation, call us at 908-879-1002. Wondering why advisors change firms and where they're headed? Are transition deals going up or down? Those very questions and more inspired us to create our annual Advisor Transition Report. It's the award-winning, data-driven resource designed for advisors that connects the dots between the motivations around movement and the firm's appetite for top talent. Arm yourself with the knowledge you need to make smart decisions. Download your copy at diamond-consultants.com/transition report.
After 30 years of advising financial advisors, including many of the most successful in the industry, we started to see patterns emerge. Sure, every advisor situation is unique, and firms evolve, markets change, and business models shift. But the underlying questions advisors wrestle with tend to repeat themselves. Questions about control, questions about growth, questions about what their businesses are ultimately worth. And increasingly, the answers to those questions are revealed in the data. That is, when you know where to look. That's exactly why we go through the yearly process of creating our Advisor Transition Report. Given our experience in the industry and countless conversations with advisors, the ability to connect the dots and offer a level of why to the who, what, when, and where, we'd be remiss not to share it with the wealth management industry at large. And this year's edition does not disappoint. If you haven't downloaded your copy yet, visit our website to get the latest version. Just from raw numbers alone, here's a spoiler. 11,172 experienced advisors changed firms in 2025, compared to 9,615 in 2024. It's an astonishing number by any measure, especially considering it happened during a historic bull market. So what's actually driving that level of movement? Where are advisors going and why? Which firms are the winners? And who's losing in the recruiting game? What models have become most attractive to advisors and why? What's the impact of AI on the role of advisor and movement? And how will it shape the industry at large? And what does it reveal about how the balance of power between advisors and firms is evolving? In this episode, Louis Diamond and I answer those questions and walk through some of the most significant findings from this year's report. We take a look at the trends behind advisor movement, what firms are offering to recruit talent, the broader questions advisors should be asking themselves about their businesses, and much more. Plus, we'll dive into some real-world transition case studies to offer greater color around what drives change. There's a lot to cover, so let's get to it. Louis, welcome.
Thank you for having me again.
Absolutely. So, for those who are familiar with this episode in years past, I think of it as the companion episode to our annual Advisor Transition Report. And I want to focus on kind of 3 main areas. Let's talk about the key takeaways from the report. Let's talk about some predictions for the year ahead. And then let's talk about transitions that happened last year that we think, not necessarily the biggest, although we'll talk about some big ones, but things that are indicative of trends in the industry that we want to point out. Sound good?
Sounds good.
Let's dive right in. And maybe I'll take the first one, which is everybody always asks, who are the winners and losers in the recruiting battle, if you will? And the winners and losers are going to sound mighty familiar to years past. It's the regional firms, certainly at the channel level, continue to see flows. So firms like RBC and Raymond James. The wirehouses continue to lose advisor share on a net basis, but I would not be so quick to write off the wires for a lot of reasons we point out in the report. Namely, they also win a lot of really big, sophisticated, successful teams. And then certainly the independent space led by LPL, but that space has gotten really deep and a lot of different flavors there. That I think continues to be where the puck is heading. So when we talk about 11,172 advisors moving, that's kind of what excites me most. There was no one winner or loser. A lot of different firms and models won advisors. A lot of different firms and models lost advisors, but at a high level, those were some of the kind of winners and losers. You want to maybe touch on the next one, Lewis, and why we think headcount, especially in the wirehouse space, is maybe a little bit misleading?
Yeah, definitely. So I think if you look at the case of UBS, they were definitely the biggest loser on a net basis of headcount in the wirehouse space. But even just looking at that, I would agree with you. It doesn't tell the full story. Wirehouse teams on average are the most productive in the industry. They tend to grow faster than average. You could say it's because of talent. Some people would say it's the way that folks are compensated, the carrot and stick approach. But there's always going to be a place for the wirehouses, in our view at least. I think what was most notable, though, about wirehouse headcount was we saw some of the largest and most notable teams in the industry change firms in 2025. By our count, 54 teams managing a billion or more changed firms in 2025, and 29 of those teams were from a wirehouse. And some went to a Morgan Stanley, another wire. Many went independent. Many went to the Ray J's and RBCs of the world. So I think if you look at these big teams, they typically are, to us at least, a barometer for greater advisor movement because the biggest teams tend to have a bat phone to the top. They're paid the best. They tend to have their firm wired. If there's referrals to be had, they get them. They get first look at retiring advisor deals. So when you see teams like this move, usually the pain that they're in has to be that much greater. And it causes other advisors to really take notice when they see the corner office team or the top team in their market pursue change.
It's funny, it pokes holes in the advisor objection of my business is too complex, which, by the way, $1 million business can be very sophisticated and complex. But when you see $100 million revenue businesses moving and going to, as you say, all these various different models, it certainly does raise the question of, or at least in my mind, answers the question of, is any business too complex to move? And it seems like the answer is no. So I agree with you. I want to talk also about tenure of advisors that move. This is a tricky one both ways because sometimes we've seen some people report numbers as far as advisor movement that are inflated or deflated. And usually the reason for that is because tenure. They're not factoring in any sort of advisor tenure into their attrition data. So that might sound insignificant, but the net effect of that is firms either lose or gain a lot of advisors in a given year that are really what we would consider trainees, people that are just out of school or who have been registered for. The metric we use is greater than 3 years. So we only count advisor transitions for those advisors who have been registered for more than 3 years. So that's our kind of quasi proxy for productivity. But even more than that, I want to say something about the tenure of advisors that move, the average tenure of advisors that move. So when we looked at this population of advisors in our report, the average tenure of the advisor who moved was 22 years, which is a really high number and frankly a little bit higher than I would have expected. Because again, productivity is certainly not a proxy for length of service. They don't necessarily go in lockstep, but generally longer tenured advisors tend to be bigger advisors. And you would think there'd be a loyalty factor, right? About 22 years at one firm on average, right? Or 22 years in the industry at one firm on average, many of whom have spent their whole careers at one firm. You would think there's an impetus to then stay put, but we're actually seeing the opposite. A lot of times it's the longest tenured teams that are in fact moving. Super interesting to me. I want to talk also, ties hand in hand with that, but sunset deals, retire and place deals, whatever you want to call them. Tell me your thoughts. And by the way, we think about these a lot of times at the wirehouse level, but it seems to me like these are not just a wirehouse thing anymore.
Yeah, absolutely. I mean, but my viewpoint is if sunset deals weren't a thing, the 11,000 plus advisors that moved in 2025 is probably more like 20,000. Complete conjecture because we'll never really know. But the sunset deals at any firm, whether a wire, a regional, an independent firm, are by far a landslide the most successful retention tools that these firms have at their disposal. The fact that they can lock up a retiring advisor really in perpetuity and then lock up their team, whether it's one advisor or 10 advisors for anywhere from 5 to 7 years, sometimes even longer, sometimes a bit shorter too, is an amazing retention tool. And also why we get asked all the time is XYZ firm going to pay retention? Our answer is they don't need to because they have these sunset deals.
Yes.
Yeah. And on the sunset deal topic, we've seen these deals get more lucrative, more aggressive. The structures have become more advantageous to a retiring advisor, whether it's locking in the production to make it a certainty for the retiring advisor or giving them some upside on growth. We've seen the structures get better for those retiring. And it's good business for these firms because if they get more people sign on to these, they're not really paying the bill on this anyway. Most of the cost is being borne by the
Sure.
inheriting team. So it makes sense for these firms to increase the competitiveness, especially for larger producers or more fee-based practices. The other, I think, big change is we're seeing really every firm try to get their hooks and advisors 10, 15, 20, 25 years before someone is going to retire and giving a one-time bonus in cash or cash in stock to sign on to the deal. And then either locking in at a baseline the terms of this deal so that someone says, hey, it's a great deal now. I get 3x to retire, even if it's 20 years away. And now I have certainty that even if the firm lowers it to 1x or 2x or 2.5x, that at a minimum, I'm going to get this. Also, very smart because once someone signs that, they typically have garden leave or another form of restrictive covenant that makes it almost impossible for them to move. One other point I'll make is the sunset deals really originated in the wirehouses. I'm not positive which wirehouse came out with it first. Whoever did deserves a big pat on the back because it's pretty genius. But now any and every firm has some sort of variation. They
Right.
all call it something different. The multiples, the structures all look a little bit different. But really, any W-2 model firm has some version of a sunset deal. If they don't, they allow their advisors to negotiate directly for what it's going to look like. And we're even seeing it creep into the independent space, which historically was you can sell your business to whoever you want, get a fair market valuation, or start a bidding process, et cetera. But we're seeing a lot of the mid and even large size independent broker dealers look to create a liquidity program to buy out folks that are looking to retire. So it's definitely a good time for folks. I think it always is to be an advisor, but folks considering retirement, you have the wirehouse deals have never been bigger on the retirement side. The regionals have it. The broker dealers are throwing their hat in the ring. And not to mention where valuations are. If someone looks to sell their business out of a wire, out of whatever firm, and sell it to typically a private equity backed RIA, those deals could be 5, 6, 7 times trailing 12 or revenue. So a lot of different options, but succession deals are certainly here to stay and have become, I think, a more compelling reason for folks to stay. And again, if these weren't a thing, the number of advisors transitioning in a given year, in my view, would almost double.
Yeah, and I'm glad you spent a lot of time talking about them because they really are that important. Like we sometimes get that question, like, "Well, you write a lot about this." Because we spend a lot of time educating advisors on both sides of this one. My two takeaways from what you just said, I think you summed it up beautifully. Takeaway number one: programs are a gift for the right advisor. If you are the right advisor, where you are certain that you, your team, your clients, your next gen, this is the legacy in place, they are a gift. Because my second point is you alluded to the competitive dynamics, and we're going to talk more about deals. But I think the firms had to offer programs like this because if you think about it, advisors have this unique ability to monetize their business by moving it. And the firms knew that. So they said, why would an advisor retire and just walk away from this when they could move the book of business elsewhere and get paid? What do you think? 4x is the top end of the market right now. I think there's partially a response to the competitive dynamics, but no doubt they're here to stay. And I actually think I would take it a step further and say, you said it, you started here, but getting more aggressive, more restrictive, more lucrative in a lot of ways too. So that's a good segue. The next one I want to talk about ties into that, which is next gen and the lack of quality next gen advisor talent in our industry. And firms have been saying this for years. And it's almost okay, great. We've identified the problem. We have, because everybody agrees, right? We have a major shortage of quality next gen talent, but the remediation to the problem has been slow. I'll give an example just using a statistic. Merrill recruited 288 total advisors. But if you'll notice, we only report 125 gains in our data. That's because 163 of the hires don't meet our criteria, meaning they were not greater than 3 years length of service. That is an example of trying to address this next gen talent problem. That's one approach to trying to address this. And I honestly think, to Merrill's credit and to the wirehouse's credit as a whole, they are doing the best job of trying to address this. In my opinion, The answer to a lot of the next gen problem, if you will, lies in specifically at the advisor level, creating incentives for quality next gen talent to get into the business because it's really hard to build a book of business and there's a lot of really lean, skinny years that are required. So what we see the most successful teams and practices do is they'll bring junior advisors on, oftentimes salaried and or supplemented by commission they're earning from the B, C, D clients of the existing book, basically carving out revenue. And that does two things. First of all, you start to bring that advisor into the fold. And secondly, you free up capacity for yourself. That's the type of structure we think probably, and it's not easy, it's not for everybody, but this is a problem that I think needs to be talked about more. It seems like everybody shifted gears to worrying about or thinking about how we're going to address the AI issue. And I think AI may play a role in helping to solve some of this next gen piece because perhaps part of the answer is some of that workload and that capacity gets offloaded to AI. We'll talk more about that. But do you have anything else on this topic before we transition gears?
I think that's right. Merrill's a really good example. Edward Jones is another one. There's a report that was circulated recently by a competitor of ours that talked about all these thousands of advisors that left Edward Jones. But if you dive into that data, a lot of the folks leaving were folks just washed out of a short training program
Yep.
or who were less than 3 years in the business. So I think those are the right examples. One more thing to mention on the RIA side, I do think that RIAs, especially these mega cap RIAs, the Mercers and Mariners and Cap Trusts of the world, I think they're going to become the new training ground for the next generation of advisors in the industry. What I'm seeing, we do this in our executive search segment of our business. The number of firms, small, medium, large, that are looking to hire advisors in general. Of course, everyone wants a book, but even firms looking for people without a book, just that they're 5 years of experience, they have a CFP,
Servicing
whatever it might
advisor.
be. The demand for those
Yeah.
folks is off the charts. And those searches have become increasingly challenging to fill because there's such a finite population of advisors who meet the needs. So I do think these very large RIAs that have lead flow, they have an investment platform, they have infrastructure, they're now large and structured enough to have training programs, to have apprenticeship programs. I think that's going to become the counterbalance to the traditional wirehouse or brokerage firm training programs.
Love it. I totally agree. I'm glad you corrected me on that point because it's true. Like the smallest of RIAs just simply don't have the cost structure to be able to afford some of what we're talking about. So somebody like a massive PE backed mega cap RIA is the perfect candidate to kind of disrupt that space. Let's do two more kind of key takeaways. And then I want to shift gears to looking ahead to predictions, our crystal ball section. Let's do one more each. So for maybe if you could walk us through. So I call it the multiple affiliation channel. That's not a good name for it. It's not such a sexy name for it, but basically this idea that firms that are offering more are winning more. And that can be either via affiliation channels or just via platform depth of offering. Tell us about that and what your thoughts are and maybe give some examples.
Yeah, no, I completely agree. And this has been I think a takeaway of ours for the last couple of years. But I don't think it's a coincidence that the top recruiting firms in the industry are typically a mix of LPL and Raymond James. And we're even seeing Wells Fargo really crack into the top 10 this year after being absent for the last number of years. And what all these firms have in common is that they give advisors choice in the way in which they affiliate. So start up as an employee, 10 years from now, whatever point in the future, it transitioned to one of our independent models. But even just the dynamic of W-2 to 1099 or 1099 to W-2 or 1099 to RIA or W-2 to RIA, like that's still a very popular and important type of transition. It's almost like a built-in put option for an advisor that I may join because I'm not ready to be independent, or I would love to be independent, but my partner who's 67 wants a deal, or the practice isn't big enough to go independent. But just the thought that I can join this firm,
Yeah.
and unless I just hate the firm, I'm never going to have to transition again. I have this built-in option is massively appealing. To me, there's never a downside to offering this to if you're a firm. But I think the extension of this concept is firms that have either recruited traditionally W-2 advisors who look at like Restored Partners, or even firms that traditionally recruit independent advisors, LPL, Cetera, New Edge Advisors, to name a few. They're all moving more into the acquisition game as well. So get recruited over, get a deal, own your practice, et cetera. And then we want to be a buyer for your business. So even that kind of version of multiple affiliation models has proven to be very important because it captures a different segment of the advisor population, but it's a similar dynamic. Come join us when you want to retire. will give you a big bag of cash at capital gains to buy your business. And again, it's a winning formula to give advisors comfort that no matter what their practice looks like in the future, no matter what their career aspirations are, that they have a built-in option that they can go to without having to go through yet another disruptive transition.
Yeah, I had an advisor. I love this quote, and you can steal it if you want. He said to me, choice, not mandate. And what he meant was he wants a firm that gives him the ability to do banking, that says you can go independent if you want to. All these, not to say he's going to end up doing all those things and not to say they're going to force him to do them, because we've seen firms go that approach too, where it's you're mandated to do certain things and it cuts the other way. So choice, not mandate, I think is the, at least for the ultimate advisor centric experience. Because to your point, I think a lot of advisors that we work with, Raymond James, Wells Fargo, Ameriprise, these firms that offer multiple affiliation channels, I'd be interested to see those percent of advisors who say, I'm joining the W2 channel, but 10 years from now, I'm planning to go independent. What percent actually ultimately end up following through with that? But to your point, it's a really nice thing to have. And it's a free option where if the firm doesn't deliver on their end of the bargain, you protect the flank.
It's also the
That-
best possible retention tool. Right along with sunset deals is firms with multiple affiliations. Look at Wells Fargo. My
True.
guess is they would have lost a whole lot more advisors over the years, given the banking scandal, if they didn't have FiNet or their RIA segment. So it's a really good retention tool as well, that someone who's independent minded, they don't have to leave the firm in order to scratch the itch.
That's the, I think, the answer to firms that what's cannibalistic to our business model, right? Why would we offer an independent channel when we have a W2 model that's more profitable? Okay, but these advisors are going to leave otherwise. The assets are otherwise going to slide off platform. So I'm glad you brought that up. I want to end our wrap up of 2025. I need to say this because I don't think we spoke about it really enough during this back and forth year. To me, two events dominated 2025. As I think about how we spent our time, especially, and our time is basically spent speaking to advisors. The first half of the year, Commonwealth LPL. The second half of the year, UBS. To me, those were the two big stories. Even if you're an advisor who's in no way tangential to those three firms or four firms, whatever, these two things matter to you, these two events, because they've rippled across the industry. I'll give an example, and we talk more about this in the report. But one way is think about what deals in the independent space have done. I can think of 4 or 5 firms that raised their deals above 100% in the independent space just as a response to the Commonwealth LPL acquisition. UBS is another good example where some of these teams leaving UBS are some of the biggest and most sophisticated teams in the industry, and they're going to wirehouses, boutique firms, regional firms, independent broker dealers, platform RIAs, launching their own RIAs. So all these firms and all these advisors are feeling the ripple effects to me of those two seminal events of 2025. When I look back on the year, that's what I'm going to remember most.
I completely agree. And I think the Commonwealth LPL deal was big, not just for competitive tension for folks considering competitors to LPL and the like, and not being able to get better deals for making the same exact type of transition, but it also took out one of the most popular and beloved independent firms. And it was another signal that if you're not affiliated with one of the largest broker dealers, there's likely some potential buyout risk, just given all the consolidation that I think, there's not that many broker dealers left to consolidate, but I think there's still more with the cost that firms are going to have to incur to keep up with AI and just keep up with the Joneses. And how can a 1,000-rep firm really pace the spending on technology and platform that an LPL does, or Raymond James, that probably spend close to $1 billion a year on technology? I think it's also big just from a moment in time standpoint. And another really shocking, but I guess if you roll back the tape, not that surprising acquisition that's driving more consolidation.
Yeah. Like in hindsight, I agree. It makes sense, but it was shocking. That's a great place to end our 2025 rewind. Let's look ahead now. And I think if we're looking ahead to 2026, we have to start with AI. It's funny. I don't even have to specify anymore. When I say AI, I'm talking about artificial intelligence. If you think about it, it wasn't that long ago that AI meant alternatives in our industry. That's what everybody talked about. I am clearly talking about artificial intelligence now for avoidance of doubt. You take this one. Tell us your thoughts on how is AI going to be a disruptive force and or a major catalyst for change in the year ahead?
I see it 3 different ways impacting advisor movement. Obviously, the impact on clients, on an advisor's day to day, on growth, on efficiency, on what the future holds. That's a topic for a different show or different episode. Looking at it strictly through the advisor transition lens, I think it matters in 3 different ways. The first one is we've started to see it and we'll see it even more. Advisors will leave their firm because their firm isn't investing enough in AI or is too restrictive with what AI someone can use. They don't allow the basic chat GPTs or Anthropics. And basically, they're forcing their advisors to fight with the hand behind their back. While every other firm and advisor can leverage all the power of AI, many firms are either in a very long kind of build process and how that always goes, or they're never really going to get to the point where they're on the cutting edge of AI. And it's going to cause advisors to leave strictly because their AI tools are not up to par. Second one, which is the corollary to it, is advisors are going to evaluate a new firm's AI capabilities just like they would evaluate their financial planning tool or their performance reporting tool or the integration of technology. And I think for many, it's going to be the number one thing that they look at, given just the power of it and how it can change. The third area where I think it matters, and I'm just last week I had 2 or 3 conversations like this, and I think it's the very beginning of seeing this more. I think a lot of advisors, just like anyone who works in the world, is a little bit uneasy about what the future of their profession looks like. And these folks, they're all different firms, different sizes, different ages. They all said something similar. I need to take chips off the table. I want to take chips off the table. I need a certain amount that I can put in the bank now through this transition to feel comfortable that if, God forbid, AI took the job of a financial advisor, that I'm set. So I think that's going to cause more movement is folks just looking to get their house in order. It's also going to change, I think, the type of movement we see. I think we'll see more M&A activity. We'll see more folks selling a minority piece of their business when going independent or in general. And I think we're going to see folks prioritizing recruitment deals and liquidity even more so than they have in the past.
Yeah. The third point in particular is a really smart point of a side effect almost of some of this AI. You're absolutely right. It's almost like this need for advisors or the want to get while the getting's good, which is a good tie in. We always get asked about who the winners are going to be for the year ahead. And this is the $1 million question, obviously, is who's going to be the best at recruiting advisors. I think the easy answer is the same firms that have been good for the past couple of years. And I agree with that largely, by the way. Like, I think the regional firm success story in particular, RBC, Raymond James, will absolutely continue. I think Merrill and Wells in the wirehouse space are both well positioned here. Merrill, because they're firmly back in the recruiting game after not being for so long. And Wells, for a lot of the reasons you've spoken about in the banking crisis in the rear view, and then multiple affiliation channels. Plus, both those firms pay very aggressive recruiting deals right now. So those two firms I would highlight. And then in the independent space, there's no question that the gap between LPL and the competitors has widened, but there are still several other large independent broker dealers that figure to make a splash. So that would be firms like Cetera, firms like Osaic, certainly the independent side of Raymond James. What we've seen historically with some of these firms is they're able to recruit advisors quicker than their wirehouse peers because the average advisor that the independent broker dealers are recruiting are typically smaller, but they also lose advisors with more frequency. So their churn rate, I would say, is higher. And I think there's nothing inherently wrong with that so long as you're continuing to restock the pond. And what we're seeing is it's getting harder and harder to recruit on the inbound side. So to your point about sunset deals, this concept of being able to retain the talent you have will become, I think, increasingly important.
I think so too. How's this going to layer on to the negative side of your prediction that the regional firm success story will continue? You can't take for granted that you have amazing recruiting years. You can't expect the music to continue. I mean, to me, Rockefeller is still killing it. They don't never really show up in our reports because they don't recruit that many advisors in a given year. But they're a good example where when they first came out, everyone wanted to talk with them. Everyone was curious. Everyone was really into understanding it. Now they're more just, yeah, Rockefeller. You like them, you don't like them, but everyone is familiar. They lost that bright, shiny object syndrome. And I feel like the regionals are always going to be at risk of that. Is what has drawn people to them is they're smaller, they're more boutique, they're flatter, easier to get stuff done. But as they have more success, they do risk becoming a victim of their own success. And now all of a sudden they're running these firms like a UBS or like a Wells Fargo or like a Merrill, where compliance always has to be managed to the lowest common denominator, and the culture and the soul of what made these firms special. I think there's absolute risk in that drifting. So I guess there'll just be a reminder for any firm leader or manager that just because your firm is killing it today, it's never a guarantee into perpetuity.
Yeah. Somebody in the media this week asked me about incumbency advantage in the wealth management space. Like this idea that if you're one of the major players, you have, and I said, I think the incumbency advantage to an extent gets you a seat at the table. If you're Morgan Stanley, I think you're in on top of people's minds for the most part, right? Advisors know, yeah, I should probably, if I'm interested in a W 2 firm, Morgan Stanley is the type of firm that should probably be on my list because they're such a dominant player in the space. Beyond that, it doesn't get you a whole lot. And in some ways, to your point, it might cut the other way because advisors have preconceived notions about a firm where, for example, we hear things all the time. An advisor says, I'm never going to another wirehouse, full stop. And they don't differentiate among the four. They just say, I'm never going to another wirehouse. So super interesting. Let's talk about deals. Have to talk about deals. Have they hit a peak? Are they going up? Give me a quick soundbite on the W-2 space and the independent space.
So usually I'm of the belief that deals have hit a peak, but they're not at risk of going down. I honestly think we're in an environment right now where I think there's still some potential room to run, just given what we're seeing on the valuation side in the RIA world. And our, now I think it's the third year we're going to say this, but our prediction that these large private equity backed RIAs are going to become a pretty disruptive force in acquiring wirehouse practices. And the multiples they're paying, which, I mean, I've seen some deals that are 6.5, 7.5 times revenue or trailing 12. That no doubt is going to have a trickle down effect to any type of recruiting deal. And I think just given the race for talent, there's, as the report indicated, there's probably 12 to 15 firms that are like are absolutely on the winning side of the ledger. That competition is going to keep driving it. And what I've seen too is once deals are in the market, expectations are reset. It wasn't that long ago that 150% all in for a top team was amazing.
W-2.
W2. And then it was 175, 200, 250, 275, 300, now up to 400%. So now advisors expect a certain number. And because of that, I think the movement could potentially stall out if deals go down or stay the same. And all it takes is one firm increasing and then someone else following behind it, et cetera, et cetera. Not to mention the crazy dynamic in the independent world where, like you mentioned, the LPL acquisition of Commonwealth in many cases increased the offer that competitors to LPL were paying by 50% or more. And once those deals are out in the market, no matter how much a firm might think they're overpaying or the ROI isn't there, you can't really backtrack on it. So I think there's still potentially room to run. In 2025, we saw independent deals really spike. We saw multiples for an M&A increase, maybe not as much as they had been like COVID and the years following it, but still going up surprisingly. On the wirehouse or traditional side, we saw Merrill and Wells really increase their offers. But also what's notable is forget about the headline number. To me, the deal structure matters far more to any advisor, any business person than the actual multiple or the headline number. And we have seen the upfronts increase. We have seen firms that historically didn't reimburse for unvested deferred comp now look to include it. We've seen firms reallocate bonuses to earlier years, which are easier to hit. We saw firms take the best 12 of 15 months to calculate some of those trailing 12. So a lot of creativity with structure, which I think is even more notable and I think better for advisors than, oh, that firm was offering 350, now they're 355 or 360. It's more so the structure, the guarantees, the upfront, et cetera, is significantly easier to hit. And there's less risk in these deals for an advisor than ever before.
Okay, so fair. I'd like to take one kind of other side of what you just said, which is there is a case to be made that because of what you just said, the idea that deal structures have changed also, that deals really haven't gotten so much materially better for the past couple of years. And the real way I mean that is not necessarily the aggressiveness of the hurdles, but the length of their recruiting note. And that's where I think while you might see headline numbers increase, a lot of times we've seen other portions of the note or of the recruiting deal get worse to compensate for that. And where that's primarily showed up is, and some advisors don't care about the length of the note, but to the extent you do, there are 10-year deals in the independent space today, and that wouldn't have existed five years ago. So just wanted to make that kind of counterpoint. Give us a prediction about either M&A or somebody going public, like something in the capital market space that you feel strongly about going into the next year. And then we'll dive into some key transitions to highlight for the year.
Yeah. I mean, I feel like every year there has to be at least one just absolute shocker of an acquisition. That's absolutely been the trend. And last year, I mean, the rumor mill was what was spinning, whether it was Stifel was going to get acquired by Raymond James or Mosaic was going to merge or get bought by UBS. I mean, some of these are, I think, fairly far flung and have since been debunked and haven't happened. But I do think we're ripe for at least one major strategic acquisition. And I don't even know where to start with a prediction. Could it be a major bank like Citi or Truist or Citizens or Fifth Third in whatever form it is now, making a big swing for a large RIA, like what Goldman did buying United Capital and then since offloading it to creative planning? It could be that, or it could even be like two historically regional firms coming together, whether it's like a DA Davidson, a firm like that, an Oppenheimer. Could one or multiple of those firms merge or sell with one of their larger competitors? So I think it's going to happen. It almost has to. We need something to use our time, and the industry press needs stuff to write about. So I do think we're due for at least one major acquisition. But I do think we will see IPOs. And as we're recording this, I mean, it's the beginning of the conflict in Iran, and there's a lot of uncertainty that lies ahead, just like there always is. But I do think we're at the point in the RIA world, especially, where some of these RIAs, and we saw Cerity Partners recap for, I think it was like $7 or $8 billion.
Yep.
Like these firms have gotten so big and so valuable that trading between private equity sponsors, it could still happen, but it may not be the best path or the right path anymore. So I think we will see one or two of these very large RIAs test the public markets. And depending upon how they do, that could be a precursor of more to come. The other option is, and we saw it with Corient, bringing in a sovereign wealth fund. I think we'll see more involvement from foreign sovereign wealth funds coming and investing in the space, almost as a bolt on or a tag along to traditional private equity firms. So, a lot of interesting things to watch as far as liquidity options for firms, and then also how that has a trickle down effect on valuations and the like. As an example, if Cerity Partners recap, I think is for reported 23 or 24 times earnings. If instead of recapping with a private equity firm, they went public and the firm is trading at 15x instead of 23 or 24, that automatically is going to have a trickle down effect on what these firms or platforms can pay in the M&A space. So I think that's going to be an interesting dynamic to see how or if the public markets receive a wealth management firm, because typically they're priced almost like a bank stock. Like we saw Focus Financial went public. I think they were and are worth a lot more than what they were traded for on the NASDAQ. And they were taken private and the valuation has skyrocketed. So I think we need a brave test case. And to me, it's going to be like a creative planning, Mariner, Wealth Enhancement Group, a firm like that has insane organic growth. It kind of checks all the boxes that an investor would look for and also has the scale.
Yeah, I think that's a very smart prediction because what you're talking about is there's become like one of the side effects of these massive, frothy private equity driven valuations is there's a fear or concern of a disconnect between like where's the ultimate. So fine, these private equity firms keep trading amongst themselves at higher and higher multiples. At some point, there needs to be an exit strategy, which was typically the IPO, but the multiple in the public space is not the same as the multiple in the private space. It makes a lot of sense. And I agree wholeheartedly with you that the quote unquote test case has to be likely to be one of the mega cap kind of players. One other option for a potential IPO candidate could potentially be a firm like Rockefeller as well, just floating something like that also, but no inside baseball. Let's shift gears now. One of the most popular sections of our report every year is representative deals, because I think advisors just like to get a lens into what are some of the most noteworthy, not necessarily the biggest, although the first one we'll talk about is indeed the biggest, not necessarily the biggest, but just noteworthy transactions. So let's go quickly here. Maybe we'll spend 2 minutes on each one. NARC, probably the largest breakaway in the history of the industry. Why does this matter for advisors and what's so significant about it?
Yeah, people are probably sick of us talking about this, reading about it, et cetera. So this, for anyone who probably was living under a bit of a rock last year, was a $129 billion team from Merrill in Atlanta, where they managed at Merrill $129 billion in assets, that decided to leave and launch their own RIA with the support of Dynasty Financial Partners and Charles Schwab as their custodian. We were lucky enough to represent this team, and I haven't been corrected, but I'm fairly confident this is the largest transition ever in the history of the industry. Forget about breakaway deal. The sheer number of people, 150 plus people on the team, close to 100 advisors, the scale of the assets, et cetera, professionally managed. Like this was massive. I think this was something to take watch over, not just because of the numbers, but because this team, to me, had every bit of complexity that stops advisors in their tracks. They worked with corporations. There was alternative investments, complex lending. The business was at the firm forever. There was a ton of different stakeholders at different points in their careers. It really checked the box on every bit of complexity. And institutional tie-in that advisors often worry about in transition. So seeing this team, which I mean, just you got to compliment the vision and the preparation
Yep.
of the founders and partners of this of OpenArc to pull this off. But to me, it indicates that no matter how big, how complicated, how sophisticated, how tied into your firm you are, that when there's a will, there's a way. And to me, that's the biggest takeaway of this transition.
Totally agree. That's my teaching when I use it as a representative kind of deal. That's my teaching as well.
Yep.
I'll take the next one. I want to talk about the Dallas based team, Executive Financial Advisors. This was not a deal that we worked on, so no inside baseball here. But the team left UBS for Morgan Stanley in November of this past year. So November 2025, 20 million in revenue. So a very big team on 3.5 billion in assets. And why we highlighted this deal, two reasons. First of all, to my point earlier, I think the wirehouses are not going anywhere. Morgan Stanley's long been a recruiting machine. Wealth management is very important to their business, with Merrill and Wells back in the recruiting game. Also, very clear to me that there are some teams that are just wirehouse types of folks. They like the brand. Their clients like the brand. They like that everything is super integrated and scaffolded and all under one roof. That's the first thing. And then the second thing is, I think the flip side of it is from UBS's side, this represented just another concerning domino, which was if you listen to the comments publicly that UBS made, they were mostly about wanting to get rid of less productive teams, right? Teams that weren't growing, not massive teams. But if you read even just read Advisor Hub every day, the teams that are leaving are teams like this, massive 10, 15, 20 billion, $20 million revenue teams with 1, 2, 3, 4, 5 billion in assets. On that transition segue, maybe you could take the next one. Let's talk about Dennis Cleary and team leaving UBS to launch an RIA.
Yes, this is another absolute whopper of a transition. So Cleary and Divine were a 6 billion or so asset team in part Boston and in part Los Angeles. Only been at UBS for I think 5, 6, or 7 years from Goldman Sachs prior. This team, they went as entrepreneurial, as independent as possible. Without a platform, without support, they went and launched their own RIA with BNY Mellon Pershing Advisor Solutions. And this was another one. I mean, this was the exact team that you want to retain forever. They were young. They probably grew faster than anyone in the industry. They'd only been at the firm for a fairly brief period of time. And just seeing a team of that size go through probably the hardest transition of all, leaving Goldman Sachs to go to UBS, but then pick up and leave a handful of years later, to me indicates that they saw something within the firm that they just couldn't reconcile. And we were lucky enough to have a relationship with this team. And all I can say is they're probably the most shrewdest, hardest working, sharpest advisors I've ever come across. And I would absolutely take them moving as a signal to anyone else within UBS.
That's a strong endorsement. I chose to cue you on that one next because to me, that is illustrative in and of itself that we just talked about two massive, sophisticated teams. Presumably, one we know is sophisticated, one based on the size, we'll assume massively sophisticated corner office teams that went to the complete opposite end of the industry landscape, right? One went to another wirehouse, one launched an RIA. And you'd say, what's the right answer? Yes, both of those could be right for them. I could make a strong case on both sides of that. So I'm glad you highlight that. Last one I want to talk about to wrap up in the independent space. There's this notion a little bit, especially in the wirehouse advisors, that a move to independence is like the end of the journey, like the end of the game of life where I've moved to independence, I'm done. But we would argue that there's a lot of different flavors of independence. And just because you've moved to one version of independence does not mean that journey is done. You've talked about capital sales or acquisitions throughout. Let's talk about a 34-person team leaving Northwestern Mutual for Cetera in Seattle. So this is a move where one business went from an independent broker-dealer to another independent broker-dealer. Can you talk a little bit about this?
Yeah, so this is a team that we were fortunate enough to send as well. It was the Pillar Group. They had over 30 years of longevity at the firm, absolutely massive as far as assets and headcount and production. And they were the top Northwestern Mutual Group in the Pacific Northwest. So just seeing a move like this, I think there's 2 or 3 big takeaways. First one is, I think we're at the beginning of more attrition from what folks would call the insurance-based broker-dealers, the Northwesterns and Equitables and Mass Mutuals and Principals of the world. And those advisors, even though they're independent or they have elements of independence, they're moving at, I think, a record clip for those firms to either the RA world or to, we'll say, more wealth management focused firms like LPL, Cetera in this case, Kestra, et cetera. So that's number one. I think the second one is some of these very large independent businesses that have been created, they're enterprises. The value that is tied up in their business is immense. And we're seeing these large groups that historically would have just sold internally at their BD, or they would have just taken the path of least resistance. We're now seeing, just given where multiples are in the independent space, that advisors are positioning themselves even 20 years ahead of a future sale to say, hey, I may sell the business in the future, I may not. I may have to transition again, I may not. But let's take the first step to really owning our business and being on a platform that lets us maximize our value. And that was the story with Pillar when they moved in September.
Yeah, and that's not just true for insurance-based broker-dealer, but that's true for any advisor. I think we call that kind of begin with the end in mind. If the ultimate goal is, I want to build something that's saleable, and you're sitting in a captive channel, or you're sitting in a firm that doesn't allow you to sell to an unlimited pool of buyers, you're probably not sitting in the right place. And that's not a sales pitch for movement. It just, maybe that was a poor example to choose, but I just use it to highlight. I think a helpful thought exercise is thinking through, what does the 20-year vision of this thing look like? And then what firm, what platform, what mode best enables me to get there? Because I hope if we've illustrated one thing throughout this conversation, it's that, A, to your point, it's an amazing time to be an advisor, but more importantly, advisors have so much choice and all of those options are legitimate. There's just different kind of pros or cons associated with each of them. So thank you so much for joining, Lou. This was an awesome episode. I invite everybody to download the report as well. We'll include instructions to do so on the episode page. Thanks again, Lewis.
As a financial advisor, you hold yourself to the highest standards of integrity, honesty, and credibility. You are successful because you take your professional responsibility seriously and are dedicated to your clients. But are you living your best business life? Are your goals aligned with your firm's, or could a better option exist? Should I Stay or Should I Go is a book written with you in mind. It's a self-guided journey that walks you through the key steps that we take with our advisor clients. This strategic thought process and roadmap to professional self-discovery is designed to help you ask the right questions and think critically and objectively, whether you're considering change or not. Learn how to get your copy at diamond-consultants.com/thebook.